Valens Research, Uniform Financial Analytics.
And so for those of you who don't know, Inditex, right? Inditex is they have Zara, they are fast fashion, if you will. They have several different brands. They are one of the world leaders in fast fashion, right? Competing with companies like H&M, Uniqlo, right? Fast clothing in Japan, also Gap. Unlike their peers, though, they've had a far stronger performance in terms of their ability to operate and their resiliency, even as many other in the retail space have actually come under significant pressure. And the reason why is because they're a better operator and they're actually paying attention to their business. And it actually jumps out when we look at what they've done the last 2 years. Right? For the last 2 years, of course, in 2020, many retailers had serious issues in terms of their operations because nobody could go to the mall. Right, and even into even into early 2020, this was an issue in several places in the world. If you're looking here, you would see Inditex, and you would see a company with fading returns. That even as it was having fading returns, it was reinvesting in its business. If you've got a company that has declining profitability, you don't want them to be plowing a bunch of new money into that business. You want them to fix the profitability of the business they already have. Right? You want to see returns not declining, but returns stabilizing before you say, yeah, plow a bunch of new money in that business. Or else you're worried you're chasing good money after bad money, right? So you look at Inditex and you say, oh no, on an as-reported basis, returns are fading as the retail space comes under pressure, just while the company's massively investing. What is going on? In reality, what you're seeing is that that's just bad data. In reality, Inditex understood that its profitability was going to potentially be coming under pressure, and so they actually shrunk their business. Right? They got smart about actually rationalizing the business even before the pandemic hit, right? Because this 2020 number actually is ending in January 2020. They were already shrinking the business, leading to returns bouncing back, right, from 2019 to 2020. Of course, in the last fiscal year, the one that just ended, right, that they haven't reported yet, returns came down. Naturally, of course, that's what happened with all of retail. But because Inditex was smart enough to already be shrinking its business before all of this happened, it set itself up for returns to rebound pretty quickly in terms of 2022, which is what sell-side analysts, Wall Street analysts already recommend. Now, there is a separate issue here, which is worth talking about, which is, right, even while that's happened, the market clearly recognizes that as-reported metrics were wrong in terms of returns, which is why the market's pricing in returns to ramp up massively. Now, what we can say is, hold on, does that really make sense, though? And that's the thing, is even though this company has had better profitability, when we can have a conversation of, all right, can it be as resilient that it already has been? We can have that conversation when we start to look at this. And one of the things that we might want to do, looking at the embedded expectation tool, is to just pull it up and say, what happens if we change what expectations are for asset growth and for return? And then what does that mean in terms of market expectations for return on assets? Because historically, right after shrinking, this company actually normally does grow at a 3 or 4% a year growth rate. Asset expectations are still relatively high. And that says even though this company is better than we realize, we probably still don't want to pound the table on it. And why that's important, though, is we're having a conversation about the resiliency of a business continuing as opposed to what on earth is the market thinking by thinking that this company can see a recovery when it's been declining, because it hasn't been declining. It's just the bad as-reported metrics that make you think it has been. Right? If we adjust that, we say asset growth of 3%, we can see as the market's expecting returns to get up here, probably still too aggressive, but at least it makes sense.
Valens Research, the world's leading source for uniform financial analytics.